Hello and welcome to myfinanceteacher.org. In this video, we're going to look again at just an overview of a range of assets. We're going to look at gold, silver, gold miners today, as well as S&P 500. But today I want to have a quick look as well at the US dollar index, DXY. We actually haven't looked at DXY for quite a while. And the reason for that is that over the last year or so, as you see from the middle of summer of 2019, to somewhere until the middle of summer this year so far, the usually negative correlation between the US dollar and gold hasn't been really that stable. The bottom part of this chart shows correlation between the gold spot price and this dollar index. If you go back before the middle of summer of 2019, you see that this correlation has been generally more stable on the negative side. And generally we see that the cycles in the US dollar index form both short-term as well as intermediate cycles. And the short-term cycles on the US dollar usually last for about a couple of months. For example, in the last couple of years, since the middle of 2018, the average for these short-term daily cycles was 59 days for the US dollar index. Looking at what's happening now to the US dollar index, it's been in the intermediate cycle all the way since the 9th of March this year. And given how oversold the 14-day RSI, we might actually be close to the end of the ongoing intermediate cycle in the US dollar. We also might be close to the end of the short-term daily cycle in the US dollar. So far today, the US dollar is green, so there is some chance that the short-term daily cycle did finish yesterday. If that is the case, then that short-term daily cycle would have lasted for 49 days, which is close enough to an average. And trying to forecast something in relation to gold price, if US dollar is to start a new short-term daily cycle, on top of that, if it's about to start an intermediate cycle, then that might actually be bad for gold if this negative correlation between the US dollar and gold is returning, as you see here, since the middle of July. The negative correlation has been relatively stable. If this negative correlation persists into the future, and if the dollar is about to bounce out of oversold situation, that might be actually negative for gold. Let's move on to gold. It is, as you see, oversold. The RSI has been deeply into oversold area. Our new all-time high from a couple of days ago is at 1981. And the ongoing short-term daily cycle is on day 55 right now. Usually these last for 1.5 to 2 months. So we still have about a couple of weeks for this daily cycle to complete with a daily cycle low, possibly giving us a little bit of a stretched cycle just over a couple of months long. The intermediate cycle is on day 132. These usually last for about a half a year, so we possibly have just about a couple of months left within the ongoing intermediate cycle. And since the short-term daily cycle is about to end in a couple of weeks rather than a couple of months, we'll possibly see another short-term bounce in gold into the last short-term daily cycle before it gives us a lower low. How low is that lower low going to be? Well, let's have a look at a few things. Firstly, I want to have a look at the Fibonacci retracement numbers. If we look at this whole rally since the beginning of the intermediate cycle, history tells us that 38, 50% or 62% retracement are the most common ones. So a drop of at least down to 1800 is pretty likely, as the 38% retracement is at $1,782. Below that, the 50% retracement is at $1,720. Call it a round number 1700. It is also pretty likely on the decline. We see that gold is red today, so there is a chance that this decline has started today. Looking at silver, silver has actually been declining for 2 to 3 days already. We see that silver has also been very deep into overbought territory and it's been considerably higher than its upper Bollinger bands as well as the 50-day moving average. Next, looking at GDX. GDX has also been overbought over the last few days, and looks like yesterday GDX tried to close this gap. Given that this gap is pretty late in gold's short-term daily cycle, I think the gap is going to be closed. There is just a little bit left to close this gap. And as gold continues down into the end of the short-term daily cycle, GDX as well, I think is going to trend down towards its 50-day moving average, as it's actually been poking through the upper range of the Bollinger Bands quite a few times already. And actually coming back to this possible low for the ongoing intermediate cycle in gold, looking at history of the previous very strong bull market in gold from early 2000s up to around 2011, I've played around a little bit with the moving averages, and it seems that this 50-week moving average, this is a weekly chart, is the one that these declines usually retest, or at least come close to retesting over here in 2010 and 2011. And in this 10-year period, it's only been once when the drop in gold went significantly further down than this 50-week moving average. And if we project that into our daily chart, 50-week moving average would be something like 250-day moving average, and that's actually at 1600. While the 200-day moving average, the one that we usually look at, is at 1628. So not that much difference between 200 and 250-day moving averages at the moment. So what that tells me is whether gold drops down to 1800 or maybe even closer to 1600 over the next couple of months. In either case, I think it's going to be a better buying opportunity than it is right now. The reason that I'm saying these obvious things is because I'm getting some comments on YouTube. Some of the viewers are actually upset about missing some part of this recent rally in gold. I don't think it's time to buy gold right now. It was time to buy gold earlier in the intermediate cycle, sometime in March or even April. And last thing for gold, let's have a look at Optimism Index in gold. As you see, it is very, very high. It's high into extreme optimism. That's, again, not the time to buy gold. You want to buy gold near the lows when Optimism Index is at least closer to 50 rather than when it's above 80. So that is it on gold. A bit of caution is now advised. Moving on to the general stock market, yesterday we saw this FOMC meeting, and in general I would summarize it as a relatively dovish statement from the Fed. As you see in this summary, the Fed is committed to using whatever tools they can and for as long as it takes to provide reliefs to the market. So let's move on to the market. With this FOMC statement, the markets are a little bit green, but as I mentioned in my previous video, I don't think the S&P 500 is going to new all-time highs anytime soon. The ongoing short-term daily cycle is 30 days old already. Usually these last for about a couple of months. So while another poke through the upper range of the Bollinger Bands is likely, I think after that we're going to see a decline into the end of the short-term daily cycle in the general stock market. So maybe a run up to 3,300 on S&P 500, followed by a decline closer to this, say, 50-day moving average. And that might actually happen over the next 3 to 4 weeks. So at the moment, I don't have any positions in S&P 500, and I don't want to chase anything at the moment. Next, let's have a look at the Optimism Index on S&P 500. Again, you don't want to chase, you don't want to buy, at least not to buy too much, when there is a lot of optimism about the market. Optimism right now is above 70 and it's pretty high. You probably want to buy when this optimism is somewhere at least below 50 or maybe even below 30. So caution on the general stock market as well. And as you see, smart money generally agrees with us. That's smart money confidence. At the moment it's below 30. And as you see, during 2020, the smart money confidence chart is a bit of a mirror image of what's happening to S&P 500. So you probably want to buy when the confidence of the smart money, that's the institutional traders, is somewhere above 70. Looking at the opposite side, the dumb money confidence, that's generally small traders. Dumb money confidence is very high at the moment, similar to general market optimism. You don't want to buy when dumb money are too confident. At the moment, they're above the red line and caution is advised. Lastly, the CNN's Fear and Greed Index for the general stock market. We aren't really at extreme greed, but the general investors are pretty greedy at the moment. Greed, as you see, has actually increased a little bit from 63 to 65. That's possibly with the dovish FOMC statement. Again, this tells you that you should be a little bit careful at the moment and possibly wait until this indicator cycles back down to somewhere below 30. That's all I want to share with you for now, but if you appreciate these videos, I would appreciate a like in return. Subscribe to the channel if you haven't. And if you'd like more detailed and frequent analysis of a range of assets, why not join us at myfinancesteacher.org. We have a range of successful investments ongoing at the moment, and all of the details are actually within this fictitious portfolio, which is actually a new service that tracks all the details of our ongoing and past trades. So as you see here, we do track a range of assets, and I publish more frequent and detailed updates at myfinancesteacher.org compared to what I publish on YouTube. That is all for now. Have a wonderful day and good luck in your trades.